Hey traders, welcome to our Wednesday, January 3rd episode of Charts and Coffee. Hope everyone's doing well. Let's get a quick audio and video check-in. Should be good to go. All right, I think we are. All right, excellent. Great to see everybody. Happy Wednesday. As always, if this is your first episode of Charts and Coffee, we take requests, we do some Q&A, took a look at the markets, and we go ahead and prepare for the day. We wrap up at 9:20, where you can head off to your respective rooms here at Simpler or check out a trial. And without further ado, let's get to it. All right, so there we go. All right, so let's take a look at what we've got going on in this market this morning. Yesterday, a lot of folks asked me, "Hey, Rog, what was it with the sell-off that we saw at the end of the session?" Basically what I was mentioning in the Simpler futures room was that, in the options room. I was in the options for the close and the futures room. But what I was mentioning for the close is that when you have a session that has pushed the upper end of the historical daily or sessions price movement range, don't be surprised for folks to, not look, as they say, a gift horse in the mouth. So you're going to want to take profits. You're going to see oftentimes the market will take profits into that kind of move because it was on the upper end of that historical volatility scale. And so can't call that a surprise once you start teetering towards that higher end. So pretty interesting in terms of where we are even now. Would I consider that gap psychology? If we're taking a look at the markets this morning, a gap is going to be when we have met two criteria. One, we're above the high of the previous session, which is a little bit different than most people do look at for gap. So look at whether or not we're opening above the previous sessions, 415, if you're looking at futures, that area, that close. I like to look at not just higher above the close, but higher above the previous session's high. So something to think about there in terms of gap psychology. All right, so first question coming up, Bank of America, you bet. By the way, these are TradingView charts. They're easy to use. They're web-based. This is one of 3 charting platforms I use, actually 4, but that's a little bit more for day trading. But I love TradeStation charts. I use the TOS charts. I've got TradingView, and I've got a little day trading charting that I use called Bookmap. So a lot of folks ask about the charts. I try not to play favorites. I like redundancy. They all tend to do different things for me. So I don't just hang my hat on one set of charts. A lot of good charting platforms out there. So Bank of America. Bank of America is interesting because, look, I don't like the XLF right now. So thank you for the question. I just don't like, Vishnu, I don't like the XLF. So everything is going to start, while I do like the S&P and I do like the Dow at the moment, everything's going to start at that index layer, then come down to the sector layer. And at the sector layer, I don't love XLF. I don't want to short it, but I don't love it. So with that being said, can we find some relative outperformance in the XLF? Right now I'm probably leaning a little bit towards Wells Fargo, just a little bit, only because it tends to have some proximity and some support, as you can see at those white dots, which happen to be the 200 period exponential moving average. But it's hard to want to bet against one of the heavily weighted sectors when the overall tide, meaning S&P and Dow, are heading higher. I've had my eye on Schwab quite a bit. And so again, just be a little bit choosy, work that relative outperformance that we talk about. All right, this is a great question. Line Watcher, what type of sell signals do I use? So if you guys have noticed, and we've been talking about buys and exclusively buys for the many months now that we've done Charts and Coffee, gang, the overall markets, let's just pull up the SPY. The overall markets are heading higher, whether it's SPI, QQQ, DIA, small caps are in fuego right now. If we have an overall market heading higher, I don't want to be looking for shorts. So when I see something like what's happening in, say, Walmart, or I see what happened recently in Baba, the idea here is even those individual stocks, even an underperforming sector like the XLP, staples within a reflation environment like we're in right now, is probably going to lag. but I'm not looking for shorts. I just know those are going to lag to the upside because, again, I believe in that boats and tide analogy. I've worked on one of my early jobs in college was a dive master on a dive boat. So, understanding the water, tides, etc. I'm an avid fisher. I love to fish. Tides are important. Tides are important in the markets too, gang. Tides are very important in the markets too, because, and by tides, I mean the larger index or the larger sector. Keep that in mind because your stocks are, unless they're not heavily weighted, we can keep the conversation about uncorrelated stocks to another day. But if they're heavily weighted, they're going to typically not move lower, or it's going to be a very small fraction of stocks that will. So rather than look for the needle in the haystack being a bullish market and the needle being that one name that's underperforming and in a downtrend, why not go for where there's a lot better choice, which is let's stick with the long side. But if you are looking at shorts, utilities, staples, uncorrelated names that are just getting hammered, that's where you want to be. So thanks for the question. Harley Creek, good morning. Good morning. So when buying an option on a double green, so that's sort of a Ragheeism for the kind of structure that I like for an uptrend, is there a specific delta I go with? So Haley and everyone else, I am a technical financial options trading heretic. I don't care about the Greeks. Now, that said, there are ways to understand what's happening in the market without putting the measuring stick of a Greek, whether that be gamma, delta, theta. I know what time decay looks like. I don't need to know the theta. We know that if momentum is not moving in our favor, if the underlying option is not moving in our favor, and we're rapidly running out of time, I know my theta is going to continue to contract and affect the value negatively of my option. I'm self-taught when it comes to options. So anything I do in options is because I have tested the ideas in the market and realized, oh, that doesn't work and that does work. I typically like at the money options bought on the opposite side of the momentum of the direction that I want to play. So I don't really worry about it. Now, that said, I'm not unaware of it. I just don't make it a point. My typical delta is going to be somewhere between 50 and 70, usually a little closer to 50. So I usually, by the way that I enter and the strikes that I look at, coincidentally, I say coincidentally because I'm not seeking a 50 or 70 delta, but it just tends to be in that range. So I hope that helps. And I hope for those of you that are intimidated by options trading, the right, but not the obligation to blah, blah, blah. These are directional plays, okay? And you can overpay for options. And I think delta is one way to understand that. But I think also using momentum and using a chart is really going to be very, very important. So thank you. Thank you for the question. Silver, James, thanks for the question. So yesterday in the free video that I do nightly for Simpler Futures, you can check that out at the Simpler Trading YouTube channel, which many of you are probably tuned into right now to catch charts and coffee. I talk specifically about what I'm looking for, and we're getting one of those two scenarios, one of those two patterns right now, and that is an inside day. And yes, I mentioned to traders who are open to an aggressive entry in silver, this would be a pretty good candidate. There's two scenarios I look at, and if you want to have a lot more understanding of this particular pattern, why I waited, check out the video, because what comes into play? The amount of the move, gang, is number one. This was actually 2 times the daily price movement range volatility that we typically see in silver. So when we see that kind of 2 times move, I want to give the market a chance to plot one of the 2 patterns that I look for, and we are getting it. So yes, this would be an aggro, but it would be a valid buy. Good morning. Good morning. Yes, Larry, it is cold in Florida. It is. I'm trying to think of what the weather is right now, but yeah, this morning, what is 51. If you're a Floridian, that's cold. That's really cold. You even mentioned the weather and I started to choke up. I don't live in Florida because I like cold weather. I don't like being cold one bit, but all the same, I'll open up the office the office windows here at some point and enjoy it. It's kind of like, remember when I had a convertible, cold weather, top down, heat on. That's exactly the way I like it. Yeah, it's cold. It's cold. It's nice though. Refreshing. But I'm ready for the humidity and the heat. Absolutely. All right. So what else do we have here? Let's go back to our charts here. Ooh, 51. All right, back to the charts. What is that grayish horizontal? Oh, sure. So Gavin, thank you for the question. One of the classes that I did, and I love the name. I didn't come up with this. My partner here in the office did. She's great at naming these things, and it's called submarket sonar. Submarket sonar is really what that indicator, which is called volume profile, is what it's all about. An anchorable volume study is a perfect and I feel necessary addition to price. Price is incomplete. Price is an incomplete look at the market. People must say, whoa, Rog, getting crazy this morning. It's the cold weather. No, price really is an incomplete look at the market. You really want 4 factors, ideally, to understand what's happening on a chart. Price for sure, of course. Volume, volatility, and time. You really want all 4 of those factors. So if you have all those factors, you're looking at the charts now from a multi-factor type measurement. All right, the market's made a high here, but was there any volume? Where is the volume on a chart? Well, why do I care? Because that is going to reveal a lot about size and commitment. In other words, we always want to, one of the questions that we're always asking is, are the big boys there? Is there flow there? Is there size at a certain level? Because it's good to be with company if the market sold off to support and you want to bounce. If you're looking for a breakout through a thin level is going to be a whole lot more, a lot easier, right? A thin wall, if you will, or a thin ceiling. It's going to be a whole lot easier than a thick ceiling. And those are important things to keep in mind. So that's actually a volume profile. That's why I study volume profile, whether that be a volume weighted average price, which I'm a huge fan of, known as the VWAP, whether it's the volume profile, big fan of point of control, value area high, value area low, and other volume levels. It's not that hard to decode. You just have to know to add it to your process. And finally, something I did create for myself back in 2008 when I was rebuilding my portfolio after the financial crisis, once again, to find out, am I able to coattail the size, right? And it's important to be able to do that. As I like to remind everybody, unless you write a check and the bank bounces, you want to coattail size, right? In other words, you want to know that you're with the larger flow. You want to know that size is committed to a direction and what levels. And that's really a helpful way to decode the market. So thank you for the question. Not enough discussion out there in the marketplace about volume. Yeah, it's a terrific question. Next question is VXRT. Hey there, Mike. I haven't had my eye on this one, but I'm happy to pull it up. It's dropping like a rock pre-market. Yeah. Oh, I mean, it's not one that I've been playing. This is interesting. This is, I don't know if this is part of the whole Wall Street bets, short squeeze scenario. There are certain stocks with high float, low price that and especially they're under $10 that tend to be moving in this way. We have to get used to this. We've seen short squeezes up close before. We've seen Goliath versus Goliath. We've seen, Ackman versus Icon. We've seen Hedgie versus Hedgie just go at it like rams. We've never seen sort of a group of retail traders versus the Goliath. We've never seen that. But again, it all ends the same. Whether you want to call it bag holders, whether you want to say who has the diamond hands, right? Whether you want to look at it as greater fool theory, which is a thing. I'm not calling anybody specifically a fool in this scenario, but greater fool theory. However you want to describe it, we've seen this before. It's a saying that history repeats itself, or history doesn't repeat itself, but it sure does rhyme. I actually like this one better. History doesn't repeat itself. People do. And I like that a whole lot better. History really doesn't repeat itself. People do. So whether the people now are retail traders and versus Hedgie or Hedgie versus Hedgie, it's kind of a familiar story. It's not that unique. And yet, I think, as always, some people are going to be caught up being late to the party. Look, a lot of us have been to high school parties. You can get there early, have some fun, or you can get there late when the neighbors have already called the cops and someone is going to be the bag holder there, right? We know this is part of it. There are going to be people late to a party. So I think it's really even more important, and I absolutely love getting together, talking about tactics with folks who want to educate themselves. If you're going to take advantage of a market that's going parabolic, you got to do it at the early stage. You got to do it at the onset. You've got to have a process by which you can recognize A, what could go parabolic, and B, the early stage of it. Okay. All right. So let's take a look at crude oil. Thank you for the question. Marty Jean, I like crude to the long side. This is very much part and parcel with an overall reflation trade environment that we're in. We're in the reflation macroeconomic environment. And because of that, commodities tend to do very well in this environment, as do stocks. Short selling is also something we see a lot of squeezes in a reflation environment. So equities tend to go higher. We've talked in previous episodes of Charts and Coffee why the assets, the balance sheet, and the M2 money supply just kind of feed itself and onward and upward. So it's hard to bet against the market, kind of going back up earlier to the question about shorts. What are my sell signals? My sell signals are really just the opposite of my buy. I need a double red. I want to look for bounces into the wave. It's just the opposite. But why would I want to focus on that in a inflation environment is the bigger question. Crude is definitely going to be a beneficiary of that. Now, a lot of folks have asked, well, Rog, did that Keystone Pipeline decision make a difference? Not really. Crude was going to head higher regardless. It probably gave it a little bit more oomph, but not really. So OPEC's decision to keep the production cuts in place. We do have crude oil inventories today, by the way, but OPEC's decision to keep those production cuts in place, it's going to keep crude heading higher. Clearly, OPEC wants higher prices in crude. They need the compliance for those production cuts to remain high, which they have been. So they need very few exemptions. I don't know that they have any major exemptions anymore from OPEC participating countries. Remember, U.S. is not an OPEC participating country. OPEC is really, by and large, Russia and Saudi Arabia. That all being said, reflation, buy the dips. That's what we're looking for. Hey, Solomon, sorry, I missed your question there earlier. Question about IGV and TAN. Well, TAN I'm bullish in. So all my cards on the table, I'm bullish in TAN. We're looking for long positions in TAN. As far as IGV, and by the way, why? Double green, right? Stick with the process. My process is ridiculously simple. That's the way I like to keep it. Trading does not have to be that difficult. The most difficult thing about trading is managing this person, right? That person. The most difficult thing about trading is how we are interpreting the message of the market and not putting in our biases and our recent losses and whatever we saw on television and all those things that can muddy up those very clear waters if we allow them to be. We just don't want to stir it up too much. What stirs up water? A lot of movement, too much complication in the process. Identify the underlying market environment. That's going to dictate what you want to do. So when it comes to IGV, maybe not my favorite uptrend, but take a look at this volume area right in here. Look how it overlaps with the wave. Overall direction of the market heading higher. Just keep in mind that if this market does pull back, it's likely going to do so in a more volatile way. So you're going to calibrate to a deeper pullback to get long. So I hope that makes sense. All right, let me see here. Let me get to the questions. Okay, so this is probably a good question to wrap up on. We're just about out of time. Hey there, Tony. So I mentioned that as far as position sizing. So in one of the accounts in my office, and welcome to my office, excuse me, in one of my accounts that I do for the Sector Secrets Mastery that I service that I have, the idea is to have an approach that's scalable. I don't want to limit anybody to saying, look, all you can spend on a position is $2,400. And the range is actually $1,100 to $3,000. $2,400 tends to be the mean for me. And that's in a very specific sized account. I would recommend that budget for folks really trading anything under $20,000 in their account, but certainly it's a little bit more friendly to a $10,000, $12,000 account. Why do I pick that? Why that number? Well, back in 2019, my husband came home to trade. You can kind of see his Let me see here. Can you see his, you can kind of see that in the corner. That's his rig back there behind the plant. He's got a little quad monitor rig back there. And he came home and, we started him off with a $10,000 account. And with that process, he doubled it. He actually did more than double it, but he doubled it in about, remember, it's a brand new trader. He doubled it in about 80 days, double that account, and actually a pretty choppy market. One of the ways we prevented a new trader, him, from blowing up the account is by giving a budget and knowing that every trade was not going to lose more than a certain percentage of that capital allocated to the trades. All he did were long calls. All he did, there were no call verticals, no put credit spreads. All he did were long calls. It was just directional. So that is scalable. Now, do I trade with a $2,400 budget? No, mine's about 6 to 8 times larger in my account. But I don't want to ever make people feel like they can't participate in the markets. They just got to do so with a more selective approach to what priced options they trade and how many of them they trade to prevent that risk of ruin, to prevent what Melvin Capital did by being down 53%. 50% is a risk of ruin, gang. So that's as good a place as any to wrap up. Thanks as always for joining me for these episodes. And I'll be back here tomorrow at 9 a.m. So head on over to your rooms. Bell's about to ring here in about 9 minutes. Enjoy your day. Follow that trend. Stick with that bullish bias. Find those names that are relative outperformers. And I'll see you tomorrow morning. Same time, same station. All right, gang. Be good to each other.